his points is very valuable. He just asked me, if you go home and you change the year, you change the rate, you change the money, dollar amount, and you don't know how to do it, right? Okay, let me summarize. When you go home, you can, whatever you want, change the number, you still can figure out. Okay. The way to summarize is, whenever you see the market rate is higher than your face rate, automatically you know you will receive discount. This is number one, right? Number two, then you sit down, you figure out the first thing, the first transaction is how much money you can receive. How much money you will receive. You know this amount must lower than the loan amount, because this is called discount, right? So you just sit down there, then figure out how much money you can receive, truly receive. At this moment, the rate to calculate the present value, when you look at the back, always follow up the market rate. So market rate 12%, 12%. Market rate is 8%, 8%. So at this moment, just to calculate how much money truly receive, you just use two rate all from market rate and go back to the back. And one is a single payment. And single payment is the face amount of the loan. It's not how much you receive, because you are going to calculate the number. It's the face value. The face value is your company liable for 100,000. So there's one single payment and determine how many years, right? And you can change the year. 5 years here, you change it 2 years, 7 years, 8 years. Try it. So that's the first step. Okay? Use the face amount, discount, or say change it back to the present value and the rate. You see the number there. And you can calculate one single payment to today's present value. There's the first number. Second one, make it complicated, is what he said. You need to use the face rate to calculate your every year interest. So, for example, if your face rate is not 10%, it's 8%, then there's 8% 10 times your loan amount. See, loan amount is 100,000, right? So if your face rate is not 10%, it's 8%, then it's 8,000. It's not 10,000. You use your face rate to calculate what is the every year annual interest payment. And it happened to me in our book, there's 10,000, but you can change the number all the time to 6%, 5%. It's okay. Say 5%, then it's 5,000 for 5 years. So what is the present value of 5,000 for 5 years? You can calculate, right? Of course, you know, if the number less, the amount is lower, then you receive less money, of course. So in our book, in this example, it's happened to 10,000 for 5 payment, and that is 3.6 something. So 5 payment of 10,000, present value is only 36,000. So it doesn't matter what kind of number you change, you put those two numbers together, you receive one number. And that is the number you will receive the cash for the day. So you just put that number on your cash account to the left. That is a cash or assets increase, the money received. On the right side, easy. Whatever the loan amount will be, just put it there, because that is your total liability. Then it doesn't matter how much difference, and that is discount. You just put the left, just remember that is under the discount, liability contract. So you just follow this method, and it doesn't matter what kind of number you change. Only remember, the number, whatever you change, you need to keep your face rate lower than market rate. If face rate higher than market rate, this is the next example. This is called premium. And the face rate is equal to market rate, and that's the case 1. It's not here.
So you're talking about the discount just the first year, then
right now, I'm not talking about first year. The day, not year. Right. The day you receive, how much money you receive on the day the bank give you the money.
So do you still pay interest?
Not yet. We will talk about that. We will talk about that. I'm only talking about the day the bank give you the money, how much. And we are talking about the payment of the interest later on, not yet. So far okay, so far okay. So as I say, I think we talk about this. We talk about this issue is, it's more than what you need already, but it's okay because I don't know. Who knows? Maybe someday you may consider to take CPA exam. And this is very, very typical CPA exam questions. So even though probably it's more than you need for today, but no harm. Right? Give you an idea about perspective. Okay, then let's talk about how about by the end of the year, the day you're gonna pay for the interest. Okay. So let's see. If you want to compare this to page 526, on the day you pay interest, we just simplify the whole thing. Okay, only by the end of the year you pay 10,000. You pay 10,000 cash. Okay, right now you pay 10,000 cash. That's true because it's 10% based on 100,000. So on the day your company paid interest, you just pay 10,000. That is what you want eventually, right? Because when you negotiate with the bank, you say, even though the market rate is 12%, but I don't want to pay 12%. I don't want to pay 12,000. I don't want to. I just want to pay 10%. And the bank say, all right, you paid 10,000, but you need to cover my loss because I am supposed to receive 12%, which is 12,000. All right, but it's okay. You just pay me 10,000. But the way to cover me is, you did not receive 100,000. You receive 92,788. So on the day when you pay 10,000, the transaction is kind of strange. Your cash truly reduced by 10,000. So cash account is 10,000 on the right. 10,000 on the right. Without discount issue. Here, case 1. When your company paid 10,000, you have expense 10,000, easy, right? But here, change. Even though you pay 10,000, your expense is more than 10,000. Which is true because your payment should be 12,000 if you follow the market rate. So very strange thing here is, even though your company pay only 10,000 cash, but your expense account is not 10,000. It's 7,200 that deficit, that discount divided by 5 years, and that number is 1,442. If you calculate, calculation. Okay, right now you start to use your discount, and discount account kick in. Very strange thing. Okay, this discount account right now 7,200 come in, divided by 5 years. Okay, that really means those deficits you receive, eventually, even though you put on under the liability, eventually they will all come out, become your expense. So this expense is not from out of your pocket, it's from the shortage of your receiving, the payment received. So you know how this 7,200 come in. You pay only 10,000 cash, But right now for each year, this contra account jump out. Okay, 1,441 each year. So your total interest expense is 11,442. So that's why the whole thing change. You have a discount, even though you pay 10,000 cash, but your expenses is more than 10,000. The extra 1,441 is not from your pocket, but it's from the shortage. From the shortage. So that's why I say at the beginning, I say, in the loan business, in the financial business, some people say you pay point to buy down. You receive $100,000, but you out of your pocket, you pay 15,000 to buy down the rate. That means your rate is more than that. Even though on the face it's 10%, but eventually you pay for 12%. Or you did not off your pocket, you receive less. Same thing. Same thing. Here. So you repeat this 5 years, repeat this 5 years. Okay? And then finally, the last year, other than this 10,000 interest, you need to pay total 100,000 cash to cover your 100,000 note payable and make the whole thing close. Okay, any questions? Any questions? I know it's kind of funny thing, you know. Any questions so far?
So does it mean every year